guys, you're gonna need to focus. Next up is how to grow your money. Investing.
You've learned how to fix credit. You've learned how loans and mortgages work. But once your money finally stops going only 2 bills, the real question becomes, how do you make money grow? Today we're breaking down stocks, ETFs, and bonds, the building blocks of investing. Segment 1. What are stocks? Stock means you own a small piece of a company. When the company grows and makes more money, the value of your shares can grow too. Some companies also pay dividends, meaning they share profits with investors. But stocks move up and down daily, so they come with risk. High growth potential, but also volatility. A simple takeaway: stocks equals ownership plus growth potential plus risk. Segment 2. What are ETFs? An ETF or exchange-traded fund is like buying a whole basket of stocks at once. Instead of betting on one company, you own pieces of many companies. For example, some ETFs track the entire S&P 500, meaning you're invested in hundreds of major businesses at once. This lowers risk compared to owning a single stock. Takeaway: ETFs equals diversification made simple. Segment 3. What are bonds? Bonds are different. Instead of owning part of a company, you're lending money to a government or corporation. They pay you interest over time and return your money later. Bonds are usually safer than stocks, but grow slower. Takeaway: bonds equals lower risk, slower growth, steady income. Segment 4. Why this matters? Most people spend their whole lives working for money. Investing is how money starts working for you. And the earlier you start, the less money you actually need to build wealth. Credit builds stability. Loans create leverage, but investing is how you build freedom. Segment 4. How is a stock priced? A stock price moves based on one simple force: supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price drops. But what makes people want to buy or sell? It's things like company profits and growth news and earnings reports, industry trends, interest rates, and the economy. Investor confidence or fear stocks are also categorized to help investors understand risk and growth potential. Common stock categories: large cap stocks, big established companies, usually more stable but slower growth. Mid cap stocks, growing companies with moderate risk and growth potential. Small cap stocks, smaller companies with higher growth potential but more risk. You'll also hear categories like growth stocks, companies expanding quickly; value stocks, companies seen as undervalued; dividend stocks, companies paying regular income to investors. So stock pricing is a mix of company performance, investor expectations, and overall market behavior. Segment 5. How ETFs are built and priced. ETFs are built by fund managers who choose groups of investments based on a strategy or index. For example, some ETFs track the S&P 500, others focus on tech companies, energy, healthcare, or even entire countries. How ETFs are chosen? Fund managers design ETFs around goals like tracking a market index, targeting industries or sectors, focusing on dividends or growth, managing risk levels. So instead of picking one stock, you're buying a bundle of investments. How ETFs are priced. ETF prices move just like stocks during the day, but their value is based on the combined value of all the investments inside the fund, called the net asset value, or NAV. If the assets inside rise, the ETF price rises. If they fall, the ETF drops too. This makes ETFs flexible and diversified while still trading like a stock. Segment 6. Bond ratings and interest rates explained. Bonds work differently because you're lending money instead of buying ownership. But the big question investors ask is, how safe is the borrower? That's where bond ratings come in. Rates bonds. Independent credit rating agencies evaluate bond issuers, including Moody's, Standard & Poor's, S&P, Fitch ratings. These companies analyze the borrower's financial strength and ability to repay debt. Bond rating levels. High-rated bonds mean lower risk. Examples: AAA or AA ratings, very strong borrowers. Low default risk, A or B. B ratings, solid but slightly riskier below BBB, considered high risk or junk. The safer the borrower, the lower the interest rate paid. Example: a government bond or strong corporation might pay 3 to 4% interest. A riskier company must offer higher interest rates to attract investors, sometimes 6 to 10% or more. Higher return usually means higher risk. Why ratings matter? If Moody's or S&P gives a borrower a strong rating, investors trust they'll get paid back. If ratings drop, investors demand higher interest or avoid the bond entirely. So bond pricing and interest rates are directly connected to trust and financial strength. Segment 7. What are annuities? Annuity is different from stocks or ETFs because it's designed to create predictable income, usually in retirement. You give money to an insurance company, and in return, they agree to pay you income later, sometimes for a set number of years, sometimes for the rest of your life. Types of annuities: fixed annuity. A fixed annuity pays a guaranteed interest rate. Example: you deposit money, and the insurance company guarantees something like 3 to 5% growth regardless of market swings. It's predictable and stable, but growth is limited. Variable annuity. A variable annuity invests your money into market-based funds. Returns rise and fall with markets. So, potential for higher returns, but also risk of losses income later, depends on how investments perform. Indexed annuity hybrid. Some annuities track a market index like the S&P 500, but limit losses. You may gain when markets rise, but losses are capped or protected. These often have complicated fee structures, so buyers need to read details carefully. Downsides of annuities. Annuities can help with guaranteed income, but often have high fees, can lock money up for years. Early withdrawal penalties apply. Returns may lag behind investing directly. They're safer than stocks, but less flexible. Annuity ratings. Annuities are backed by insurance companies, so financial strength matters. Ratings come from agencies like AM Best, Moody's, Standard & Poor's, Fitch. Highly rated insurers are safer because they're more likely to meet long-term payment promises. Segment 8. What is a 401k? A 401k is a retirement account offered through your employer. Money comes directly out of your paycheck and gets invested automatically. How it works? You choose how much to contribute from each paycheck. Employers often match part of your contributions. Money is invested into funds chosen inside the plan. Investments grow tax-deferred until retirement. Important detail: you usually don't manage the investments directly. If your employer hires a plan administrator or investment company that provides fund options, you choose from their menu, but you don't control every investment decision yourself. Downsides of a 401k: limited investment choices. Fees can be hidden inside funds. Penalties for early withdrawal before retirement. Taxes owed when withdrawing later, but employer matching often makes it worth using. Segment 9. Roth IRA explained. A Roth IRA is a retirement account you open yourself, not through work. You contribute money that's already been taxed. How it works: you invest after-tax money. Investments grow over time. Withdrawals in retirement are tax-free. That's the big benefit. Benefits: no taxes later on growth. Flexible investment choices: can withdraw contributions early without penalty. Great for younger investors expecting higher income later. Segment 10. Traditional IRA explained. A traditional IRA also lets you invest for retirement, but taxes work differently. How it works: contributions may reduce your taxable income now. Investments grow tax-deferred. Withdrawals in retirement are taxed as income. Key difference: traditional IRA equals tax break now, taxes later. Roth IRA equals taxes now, tax-free later. All right, let's bring it all together. You've learned the building blocks of investing. Stocks: ownership with growth potential and risk. ETFs: diversification made simple. Bonds: lending money safely for steady income. Annuities: predictable income, fixed or variable. 401k: employer-managed retirement plans. Roth and traditional IRAs: tax strategies for long-term growth. Each of these tools works differently, and each has a purpose. There isn't one right answer. It's about understanding how your money can work for you instead of just sitting in a bank account.
Ow.
The biggest advantage you can take today is knowledge. The earlier you understand these options, the sooner you can start making informed decisions and growing your wealth. This is just the foundation. Cash 101 is here to help you cut through the myths, avoid the traps, and make money actually make sense. Follow along, because next we'll go deeper into how to actually start investing step by step without costly mistakes. Remember, money is power, but knowledge is the real wealth.